Okay, guys, I'm often asked why I say less is more. Because surely in trading, you should be trading more. The more you do, the more you get. The bigger your size, the bigger the profit. But is that strictly true? Actually, no, it's not. I learned a very, very long time ago. If you hammer the markets all the time, just because they're open, you're probably going to be on the wrong side of a trade more often than not. Why? Because the markets move in such a way they're there to shake out weaker traders. Now, weaker traders will be drawn to 5-minute and 1-minute charts, and that's about as far as they get. They don't look at the hourly charts, they don't really look at the 4-hour, or if they do, they're certainly not looking at the day, week, and month. Why? Because they think it's too far away. And to a degree it is, but it will show sentiment of the market. So if you see a great sell setup, but the bigger picture is buy, what you're doing is you're selling into a buying trend. Now, depending on how well you know the market, what if you're at the bell curve? Well, the bell curve is where it's sold down and then resumes back to the way it was going. You're on the wrong side of the trade. So less is more really comes into it. Now, for me, I'm what's called an hourly trader. I take a signal from the hour and I'll enter on a 15 or a 5-minute. But the 15 and 5 has nothing to do much with the direction. It's only a confirmation to confirm the direction I've already agreed to go in. Now, the hourly is the lowest point that I want to go to. I'm actually taking it from a broad stroke in the higher time frames because I'm a big believer in if you get the direction right, it'll forgive the entry. If I've got the entry wrong, but I've got the direction correct, I can do what's called DCA, which is dollar cost averaging. I can negative average into the trade quite safely and get myself a better price, get myself a better profit, reduce the exposure at the same time. And then when it resumes back to the direction that I've agreed on, I will get a bigger payday. Now, that's only one element of the trade. Now, the next element of the trade is how big a position size did I want to put on in the first place? Now, I work to basic formulas, pound 1,000, 10p 100, that sort of thing. And what that does for me is it does a quick ready reckoner without doing mathematical gymnastics of going, well, I'm putting 2% in the count on. That equates to this, but the dop's going to be there, so it's going to be that. And you sort of drive yourself in knots trying to work it out. It's dead easy. If you agree to a financial figure, so let's just say you're a pound 1,000, okay? You will say, well, I'm going to put £1 on each position I put into the market. Now, if you're very conservative, that can be £1 split across your averages. If you're a bit aggressive, it can be £1 on each one. So if you have 3 positions into the market, you'll put £3 on. If you're going to be a bit conservative and you're going to just use £1, it will be 33p position, a third of it. Just an easy math sort of thing. Then you've got to figure out how much you're willing to take into the trade. Now, this needs to be a financial figure, not really percentages, because if percentages work the way that everybody bandies around, you only do 1%, you only do 2%. If you've got a small account, you've got nowhere to go. You're going to get cut to ribbons. So you've got to put something on the line. Now, if you've got £1,000, you might say, well, this trade will cost me 50 quid. I am only spending £50 on it. Now, 50 quid against 1,000, it's not that big a hit if you think of it in money terms. You might even be conservative and say, well, I'm only going to do 20 quid. 20 quid, I've agreed to it. Once you've agreed to the financial figure, the trade becomes easier because you're not pressured anymore. You've agreed to it. Now what you've got to understand is how you're going to apply yourself to the chart. Now, I don't believe in the way they do this. They'll go, well, I'll put my stop there because it's 1% of a count. Stupid. Because the market doesn't know it's 1%. All the market knows it's moving. You're probably putting that in front of the freight train. So you've got to understand market structure. That's where the levels are, where the Fibonacci levels are as well, because they're mathematical ratios. Then you've got swing points. Then you've got different moving averages. All these different elements. You can look at a VWAP, see where the bell curves are. All the different elements. And once you've established where they are, then you can figure out where the stop's going to be. Well, if you're agreeing to £1 a point and it's 20 quid for your trade, that means that stop has to be within 20 pips. What if it's not? What if it's at 30? Well, then you have to reduce your position size. Reduce it by half, gives you a 40 pip allowance. And if it's at 30, well, it's inside that allowance. Job's done. That's where the stop ends. It started and ended before you've even pressed the button. You've agreed to it. You know where it's wrong. We can now move to the next stage. How much am I going to get out of it? Well, works the same way. Level, bell curve, moving average, Fibonacci levels, they're all stall points. That's the profit. You need to separate the two altogether. And most traders go through the recycled garbage that's on YouTube. You got to risk 1 to get 3. What if the market's not willing to give you 3? What if it's only meant to give you 1 or even half? You don't know. Case in point. Been watching cable this morning. It's gone nowhere. Absolutely nowhere. It's gone up a couple of fractions, it's come down a bit of fraction. Gone up a bit of fraction, come down a bit of fraction. Now, I am actually trading at the moment. It's 24 quid against me. Am I worried? No. Because I know as far as it goes is about here. Now, on the first position, that'll give me 26 quid. I'm happy with that. But I've already banked money. So I've got, well, room in my petrol tank. So if I kill this off now, it's hardly affecting me. Okay? But it's ready to rock and roll. So what's that telling me? Well, when you look at that, it ain't going anywhere. And it's been like that all morning. It's currently 1:30. So I'll just sit and I'll play it out. This will cash out over the course of the next hour or so. And that's fine. But now it comes down onto trading times as well. Because less is more also doesn't mean the amount of times you go to market on a single day. It's when you trade. So Monday for me is a terrible day. Absolutely terrible day. If I get 1 trade in a day, happy. If it's a scalp, great. It's just added bonus to the rest of the week because I work it on Tuesday, Wednesday, Thursday. Why? Because Monday sets the market up. Trading on a Sunday, well, just forget that because spreads are so wide and the markets haven't opened yet and the traders who are actually going to move the markets haven't come into play yet. So that's sort of like suicide, right? So you kind of forget your weekend trading unless it's crypto. Now, Monday morning is a nightmare. So that writes off pretty much all of your trading till about 10 o'clock because you need to see the market set. I saw it set today and I saw it set. It ain't going anywhere. It's just going to be pretty flat. So 1 trade will do. Tomorrow, the markets will have settled down. I'll be able to get 2, maybe 3 trades in. I'll work on 2, score, stop. Because if I do £100 a trade, it gets me 200 quid for the day. 200 quid for the day across 3 days, 600 quid a week. 600 quid a week across 48 weeks is roughly about 30 grand. I'm more than happy with that. You know, anything more, brilliant. So if that generates that amount of money, Scruff's happy boy. Okay. Now, when it comes to Friday, it's the other way around. Friday, regardless of what, and I've had this argument all the time, but if you go through Reuters, Bloomberg, any financial paper on trading times, they all tell you the same story. A retail trader trading past noon on a Friday is nothing, it's just asking for trouble. Now, I could start going, well, it's not better the week and everything with the thing, but I'm trying to calm down a little bit, and I'm stepping away from the channel somewhat because I'm kind of wasting my breath. But there are certain people that are interested, which is why I do this. Now, Friday afternoon, if you're caught, you are really caught, because you can't get out of it till Monday, because the spreads widen up on a Sunday, which is why Sunday is a terrible day to trade. Then you've got to take on the open on the Monday. You've got no idea which way it's going. So it can damage you heavily by trading after 12 o'clock on a Friday. Now, that includes Bitcoin as well, because it does die down slightly. And when I see people diving in at the markets like 6 o'clock on a Friday night, I just think, what are you doing? Why? Have you not got a life? You know? Just calm down. You're better off looking at it on a Saturday, but even on a weekend, the Bitcoin, because it is one of the only markets that has a little bit of liquidity that it can trade, can still be pretty hard work. I mean, I watched it this weekend and certainly over the last couple of months, and it doesn't do a great deal on a weekend. You know, a few quid out of it if you're lucky, but that's about it. So less is more. If you were taking 10 trades, half it to 5. If you're trading at one lot, drop it to half a lot. All these different things. Okay. And then if you're trading 7 days a week, drop it to 5. Try and cut back. And what you'll find is that cutting back will save you a fortune in the long run. Because not only will it save your bank account, it'll save probably your relationships as well, because this is another thing. I've seen a lot of people trade, and then trade some more, which creates revenge trading, and they'll actually put the mortgage money into the markets because they've lost money, which then creates a problem at home. So your mindset is a big thing as well. And the more you trade, the more damaging it comes to your mental health. Now, I'm not big on mental health. Simply because I think you should be sensible enough to realize things, but I do realize some people are quite fragile and they can get consumed by it, and then that consumption manifests themselves in anger and temper and various other bits and pieces, because whatever emotions you're going through, trading will pull it out. It'll pull out anything, whether it's revenge trading, anger, depression, even jealousy, and it'll amplify it 10 times because there's money involved. And the word you'll hear me say is quite regular: money will see you out. It will always show you the real person. So think about what you're doing. If you're stuck, I'm easy found. You know, by all means, drop on the WhatsApp group and follow that. You'll see my write-ups. And I keep a running total of all the videos that I do there as well. But you'll also get access into the Discord. It's free. You can come along and you'll come in as a guest and one thing and another, and just talk to the guys. That's all I ask for you to come into the Discord. Just talk to the guys. And if you sit there in silence, well, you're not going to get anywhere. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.